Welcome back to Cardboard Box Finance, where we explore the fascinating world of economic history and the lessons we can learn from past crises. In today's video, we delve into the captivating stories of 25 lesser-known economic crises that have shaped the course of history. From the obscure to the extraordinary, join us on this journey as we uncover the hidden narratives and unravel the consequences of these often overlooked events. Throughout history, economic crises have shaken nations, tested economies, and challenged the resilience of societies. In this video, we shed light on 25 lesser-known crises that have had a profound impact on the financial landscape. From the Panic of 1720 to the Great Recession of 2008, we bring you stories that will intrigue, educate, and inspire. Join us as we delve into the intricacies of each crisis, examining the causes, the warning signs, and the aftermath. We will explore the ripple effects that spread across industries, nations, and generations, revealing the complexities of economic systems and the fragility of financial stability. As we navigate through these lesser-known crises, we will uncover valuable insights and lessons that can help us understand the present and prepare for the future. By studying these historical events, we gain a deeper appreciation for the dynamics of markets, the role of regulation, and the impact of human behavior on economic outcomes. So, buckle up and get ready for a captivating journey into the depths of economic history. Join us as we shed light on the crises that shaped our world, and let's embark on a quest to learn from the past and build a more resilient future. 1720, the South Sea Bubble was a financial crisis in England caused by speculative investments in the South Sea Company, which promised significant returns on investments in trade with South America. However, when the company's stock prices collapsed, it led to a widespread panic, massive financial losses, and significant economic turmoil. 1745. The Panic of 1745 was a financial crisis in France caused by the collapse of John Law's Mississippi Company, which had been granted a monopoly on trade with French colonies. As confidence in the company eroded, its stock prices plummeted, resulting in bankruptcies, economic instability, and social unrest. 1763. The Panic of 1763 was a financial crisis in Sweden caused by the failure of the Swedish East India Company, a trading company established to promote Swedish trade in the East Indies. Its bankruptcy and subsequent economic repercussions led to widespread financial distress and economic instability. 1783. The Panic of 1783 was a financial crisis in the United States that occurred after the American Revolutionary War. The country faced significant economic challenges, including high levels of debt, a decline in trade, and an unstable currency, which resulted in economic hardships for many. 1804. The Panic of 1804 was a financial crisis in the United States caused by land speculation, excessive credit expansion, and an economic downturn. The collapse of land prices, bank failures, and a contraction in trade led to a period of economic distress and instability. 1819. The Panic of 1819 was a financial crisis in the United States triggered by a collapse in cotton prices, excessive bank lending, and land speculation. This combination led to widespread bankruptcies, foreclosures, and economic depression, affecting various sectors of the economy. 1844. The Panic of 1844 was a financial crisis in the United States caused by excessive lending by state-chartered banks and speculation in government bonds. When states defaulted on their debts, it led to a severe economic downturn, bank failures, and widespread business closures. 1857. The Panic of 1857 was a financial crisis in the United States, triggered by the failure of the Ohio Life Insurance and Trust Company, one of the largest financial institutions at the time. Its collapse created a chain reaction, resulting in bank failures, unemployment, and a decline in business activity. 1864. The Panic of 1864 was a financial crisis in the United States caused by the contraction of credit, declining agricultural prices, and disruptions in international trade during the American Civil War. It led to economic hardship and financial instability for many businesses and individuals. 1882. The Panic of 1882 was a financial crisis in the United States caused by railroad speculation, bank failures, and a decline in business activity. The collapse of several major railroads and subsequent economic downturn resulted in widespread financial distress and a period of economic recession. 1895. The Panic of 1895 was a financial crisis in the United States triggered by the failure of the Reading Railroad, one of the largest railroad companies at the time. The collapse of the company and its associated banks led to a wave of bank failures, a contraction in credit availability, and a period of economic turmoil. 1902. The Panic of 1902 was a financial crisis in the United States caused by the Northern Pacific Railway bankruptcy and subsequent stock market decline. This event led to a contraction in credit, declining business activity, and economic uncertainty, highlighting the interconnectedness of the financial and railroad sectors. 1912. The Panic of 1912 was a financial crisis in the United States caused by a sharp stock market decline and concerns over banking practices. It resulted in bank runs, liquidity shortages, and a period of economic instability, exacerbating the economic challenges of the time. 1921. The Panic of 1921 was a financial crisis in the United States triggered by a decline in agricultural prices and a contraction in credit following World War I. It led to a period of economic recession, high unemployment rates, and financial difficulties for many businesses and individuals. 1929. The stock market crash of 1929, also known as Black Tuesday, marked the beginning of the Great Depression. It was triggered by a collapse in stock prices, leading to widespread bank failures, unemployment, and a severe economic downturn that lasted for years. 1931. The Panic of 1931 originated in Europe and quickly spread worldwide. It was triggered by a series of bank failures, currency devaluations, and the collapse of the Austrian Credit-Installed Bank. This event resulted in financial turmoil, a contraction in trade, and economic hardships in many countries. 1933. The Panic of 1933 was a financial crisis in the United States, caused by a series of bank failures and the closing of banks during the Great Depression. The resulting loss of confidence in the banking system led to a period of economic distress and uncertainty. 1937. The recession of 1937, also known as the Roosevelt Recession, was a significant economic downturn in the United States. It was caused by a decrease in government spending, tightening of monetary policy, and a decline in business activity. The recession highlighted the challenges of economic recovery during the Great Depression era. 1945. The post-World War II recession was a period of economic slowdown that occurred after the end of World War II. As countries transitioned from wartime to peacetime economies, there were challenges in readjusting production, managing demobilization, and stabilizing currencies. 1950. The recession of 1953 was a downturn in the United States economy caused by the demobilization of troops after the Korean War and a tightening of credit. The combination of these factors led to a contraction in economic activity and increased unemployment rates. 1958. The recession of 1958 was a severe economic downturn in the United States. It was caused by a combination of factors, including high interest rates, declining auto sales, and a decline in industrial production. The recession resulted in widespread job losses and business closures. 1969. The recession of 1969 was a significant economic downturn in the United States. It was triggered by a combination of factors, including inflation, a decline in consumer spending, and a tightening of credit. The recession highlighted the challenges of managing the economy during a period of social and political changes. 1974. The recession of 1974 was a prolonged period of economic downturn in many countries triggered by the 1973 oil crisis. The crisis resulted from an oil embargo imposed by the Organization of Arab Petroleum Exporting Countries, OAPEC, leading to high oil prices, stagflation, and economic instability. 1989. The savings and loan crisis, also known as the S&L crisis, was a financial crisis in the United States. It was caused by the collapse of numerous savings and loan associations due to risky lending practices, inadequate regulation, and the bursting of the real estate bubble. The crisis resulted in significant taxpayer-funded bailouts and a restructuring of the financial industry. 1997. The Asian financial crisis originated in Thailand and quickly spread to other Asian countries. The crisis was triggered by a currency devaluation and financial contagion, leading to stock market declines, currency collapses, and economic turmoil. It highlighted vulnerabilities in the region's financial systems and raised concerns about global economic stability. These additional economic crises demonstrate the historical recurrence of financial disruptions and their significant impact on economies and societies. They serve as reminders of the importance of robust financial regulations, prudent risk management, and coordinated global responses to prevent and mitigate such crises in the future. As we conclude this exploration of lesser-known economic crises, we hope that the stories shared in this video have broadened your understanding of the complexities of the financial world. Remember to subscribe to our channel and hit the notification bell to stay informed about our latest videos. Join us next time as we continue to uncover the hidden histories that have shaped our economic landscape. Together, let's delve into the lessons of the past to navigate the challenges of the present and build a stronger financial future.